Hi, welcome back to the Keiser Report. Time now to go to sunny Los Angeles and talk with Mike Maloney of GoldSilver.com. Mike is the author of Rich Dad's Guide to Investing in Gold and Silver, and he has been traveling the world making some fantastic videos about gold and silver. You can find them all at GoldSilver.com. Mike Maloney, welcome to the Keiser Report.
Glad to be here, Max. How you doing?
Fantastic. Now, Mike Maloney, I've just been watching your video, Dead Cat Bounce. Bernanke is dumber than gold, which I guess is a play on the phrase richer than God. And then there's Bernanke, he's dumber than gold. You believe we are just entering into a quote-unquote true deflation. Talk to me about this.
Well, I wrote in my book, I started writing that in 2005 and I finished in 2007. And what I said was we were going to get the threat of deflation, followed by a bunch of bailouts and currency creation by the Fed, which they did. Then we would have real deflation, meaning a contraction of the currency supply. And that is happening. There's some private companies that reproduce M3, which the Fed hid from us in March of 2006. But these companies reproduce it, and I believe they are quite accurate. And it shows a $1 trillion collapse of the U.S. currency supply, and that's about 10%. It's almost 10%. The markets in the U.S. are way overvalued. They're back into a bubble. The PE ratios for the S&P are over 20. That's bubble territory. When you look at dividend yields are about 1.9%. That is lower, meaning it's a bigger bubble, than the first 118 years of data from Robert Shiller of Yale University. He constructed the S&P going all the way back to 1880. And there is no time from 1880 to 1998 where dividend yields were lower than this, meaning a bigger bubble in the stock market. And one thing I have observed is that since the year 2000, all of the stock markets have started to become linked together. They all are in lockstep with whatever direction the U.S. stock market is going. And so as the U.S. stock market goes down, it should drag the rest of the world with it. We should see deflation, followed by governments around the world panicking, and I do believe that they will print us into a hyperinflation.
All right, let's talk about this word deflation for a second, because people associate deflation and the collapse in money supply, as you point out, with a rising dollar and a paper currency like the dollar having an increase in purchasing power, as we saw in the 1930s. Of course, in the 1930s, the U.S. was on a gold standard. The U.S. is no longer on a gold standard. So am I correct to presume that lacking the gold standard, the deflation, the contraction in the money supply, and the response, which is to print lots of money, will have this inflationary or hyperinflationary effect? But what accounts for the lag time exactly between the contraction of the money supply, the printing of the money, and its eventual hyperinflationary collapse?
Well, what is responsible for the lag time is the fact that the portion of the currency supply that governments produce is very, very inefficient. The major portion of the currency supply in the United States, for instance, 85% of all the dollars created are created through fractional reserve lending. So it's the public borrowing currency into existence, and it's very efficient because it goes right into real estate, into business, into purchases people are making with their credit cards. When the public pulls back and they get frightened, they stop their borrowing and spending, the currency supply starts to collapse. If the government decides to do a bunch of treasury purchases, for instance, to create currency where the Federal Reserve, a private corporation, is buying U.S. treasuries, which indebts the public in the future to a private corporation. It's a crazy world. But if they do that, it takes quite a while to filter through the government to get out into all of these spending projects, and you lose all of this energy as it goes through the different government offices and the bureaucracies. So it takes many, many times more currency produced to have the same effect that the public gets when they borrow currency into existence. So that is responsible for the lag time. But in the last deflation, gold rose from $20 an ounce roughly to $35 an ounce, and that really was the will of the public and the free markets doing this, because it was a change in exchange rates. And then once they unpegged the dollar from gold, the dollar's value fell from 1/20th of an ounce of gold down to 1/35th. So it was really the dollar changing. The rest of the world was using gold, so it wasn't gold changing. It was exchange rates around the world figuring out that the dollar wasn't worth as much. The gold actually rose in the deflation, so even though the dollar gained in purchasing power by 50%, gold magnified that by another 70%. It's doing the same thing today. Gold is basically just fundamentally undervalued. It doesn't purchase enough stuff. I don't care about gold's price. What I care about is how many shares of stock does it purchase, and how much real estate does gold purchase at the time. And right now, it doesn't purchase enough. It is re-exerting itself, and it's going to purchase more stuff in the future. So even if the dollar gains in purchasing power temporarily, gold will magnify that gain. I believe that if we went into a deflation and stayed there, you'd still see gold up at $3,000 an ounce, and you'd see the Dow down at like 1,500 points. So gold would be double the points of the Dow.
All right, Mike Maloney, you have been all over the world shooting videos, talking to people in the gold industry and banking industry. Talk to me a little bit about China. I see China is just at this time launching a new exchange-traded fund. They're encouraging people in China to buy gold and silver. What's happening in the China story right now in gold?
The Chinese have always been attracted to gold. It is part of their culture. What's off the radar still there is silver. And when they start coming into silver, you are going to see an explosion that is nuclear. It'll be unlike any financial asset the world has ever seen. Silver is a very, very small market, and word is getting around. It isn't just China. China is going to make a big, big difference. One of the things that I have been teaching on my travels is that the last bull market in the 70s of precious metals was only North America and Western Europe participating, and it was a very small percentage of the population. This time, it is the entire world. If you look at the USSR, they couldn't buy gold, and they didn't have an exchange that helped set the price of gold. The spot price was set on the London Metals Exchange and the Commodities Exchange in the U.S. Those are the only two places where the spot price of gold was set. Today, it's set by exchanges all over the world. Everybody can buy. There's not enough of it. There's not enough silver. The whole thing is going nuclear. It's going to be huge.
Now, China has come out publicly and said that they need to increase their gold reserves by 3, 4, maybe 5,000 tons to try to catch up to the U.S. They've been stealthily buying gold for the last few years. They've raised their reserves in gold up pretty sharply. But now they've said we've got to buy a few thousand tons. Is this really... how are they going to do this without moving the price substantially, or is it just all bets are off and it's a mad scramble at this point for gold?
Yeah, if they do what they're saying, then you're going to see the price double, quadruple, or more than that, unless there's another government secretly supplying them. Now, if you talk with GATA, they have a lot of evidence that the United States and some other central banks have been selling gold into the markets. China could acquire, if the U.S. wants to keep the price of gold down, and China has that demand, I don't know. But the only way that China could accumulate without causing the price to just absolutely explode would be for another huge holder of gold to let it go without it hitting the markets, to be a private transaction, basically.
Yeah, well, no country has that supply of gold outside of the U.S. Germany has 3,000 tons or so, but most of that's held in New York, and then the list gets smaller from there. I want to move on for a second to Ben Bernanke, the Federal Reserve Chairman. He was on 60 Minutes TV show recently. He made the statement that he understands he's flooding the system with lots of fiat money, but if need to, he can simply, within 15 minutes, start raising rates and reverse the damage and drain the system. Is that really plausible or possible?
Well, he can raise the Fed funds rates, but if there's a whole bunch of currency out there, base money is what it's called, that he creates. If there's too much of that out there and too much of it on the bank's balance sheets, you could see fractional reserve lending. Like I said, the major portion of the currency supply is not created by Ben Bernanke. It's created by fractional reserve lending when the banks create loans for houses, for cars, when you sign a credit card receipt. And so if the public gains confidence again and they feel good and there's too much base money out there, you could literally see a hyperinflation with the printing presses turned off. Ben Bernanke has influence over the bank's interest rates. He does not have control over them. He influences them through something called open market operations.
Right, and I guess if you listen to folks like Jim Rickards over there at Omnis, he'll point out that the money that is in the system is spread out over multiple maturity dates. So, yeah, in the short term, he might have an effect, but you can't really go down into the maturity yield curve, I guess you could say, and totally reshape it based on his will.
He's dumber than gold. They're all dumber than gold. They think that they can control the free markets. All they can do is temporarily manipulate. And when they manipulate, energy builds up and the free markets eventually overwhelm the manipulation. And this is the reason we're going to be seeing far, far higher gold prices. We're going to be seeing increased deficit spending in the future. It's not going to be decreased. This monetary system that we've got now, its days are numbered.
All right, Mike Maloney, thanks so much for being on the Keiser Report.
Thank you.
All righty, and Mike Maloney's site is goldsilver.com. Check it out. He's got a lot of information and videos linked to that site. And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Mike Maloney. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.